Hello, I'm Sarah. I'm a private client tax partner based in the Exeter office at Francis Clark, and I'm joined by my colleague Lyndon.
Hello, I help lead the wealth management service for Francis Clark.
So we're here today just to have a little sort of debrief post-budget last week. I think ahead of last week's budget, I think there was a lot of speculation in the press. You know, what's in, what's not. I think we were concerned that there was going to be an increase in income tax, sort of changes around the inheritance tax a bit more so than what they'd already done last October, even like an exit tax for those individuals leaving the UK. But I think, you know, there was a leak, which I've never seen before, and you probably haven't. So you probably knew more about the budget before Rachel Reeves even took her position at the podium to deliver it. So I don't know what your thoughts were around.
Yeah, no, absolutely. I think it definitely sowed seeds of confusion and didn't paint the government in a very good light whatsoever. But from a planning point of view, I think we have to take a step back and see this, what feels like a non-event, in the context of last year and this year's budget. And really, it is starting to really constrain clients who've typically been able to take quite a passive, buy and hold strategy with their planning and their investments, really. And that really peaked in 2022 when capital gains tax allowances started to come down. And we've seen a compounding of this freezing of allowances and that sort of shrinkflation that I call it, how to get a shocking reduction in bang for your buck without shocking headlines. You do it through the Toblerone effect, where you sort of widen the gap between the package and the contents and sort of widen the gap between the pyramids, and price is still the same but actually much less inside.
And I think that was the thing, because that was one of the major takeaways for me, is the freezing of those income tax thresholds. Because if you'd actually put it out there and raised income tax, that would have been a massive headline. But this one's what I would call a stealth tax, because you don't really know it's happening, but what you're going to find is those middle income earners that are going to be pretty hit by that. And especially as wages increase, you're going to probably see more people within that higher rate tax band bracket, which you wouldn't normally have had before.
Exactly, and it's effectively reduced the personal allowance from about 12,500 to around 10,000. And the higher rate threshold from 50, just over 50, to around 40,000 effectively. And imagine the headline had that been the case, but by stealth, over time. But not just that. If we look at the capital gains tax annual exemption over the last few years has fallen by 75%. Cash ISAs for under 65s will be falling by around 40%. You've got dividend allowance that's dropped by 90%, compared to its peak. So there's again, over time, these allowances have really constrained investors' ability to self-manage, and I think we need to take a much more hands-on, professional, broader approach with regard to wealth and investment planning.
And I'd agree with that. And I think we saw a lot last year with the budget around inheritance tax, with the business property relief and agricultural property relief, the allowance coming in of the $1 million, which is set to come in from April 26. And I think for years and years we probably talked to clients about inheritance tax planning, and it's very low on their list, on their radar. But I think what I've seen, especially over the last 15 months, is that now inheritance tax is coming like a priority, top of the list. So you're having more and more of those discussions and what we can do. And I'm sure that you're seeing that with your investors.
It's the same with pensions, it's the same with estate planning, really. I totally agree. So again, these are further examples of the worst thing that could have happened with these assets was actually an event during lifetime, say selling a business or disposing of an asset. So it created a capital gains tax event, rather than dying with the asset, and also then it brought the proceeds into the estate for inheritance tax. So a huge tax event, if anything happened. But that's really reversed now, and we're seeing clients really focused on succession planning, ownership, how we actually expand ownership to include trusts as well, and that's helping to broaden out the use of the allowances that are now part of the new regime for business relief, agricultural relief, so much more hands-on.
Yeah, and there's still that planning available because obviously the rules are coming in from April 26, but there's still that opportunity to sort of bank those BPR and APR allowances by using the use of trusts prior to April 26. So we're definitely seeing that with a lot of business owners and doing some planning ahead of that. I think sort of my other takeaways from the budget is, again, it's like we've got those middle income earners, but it's also those sort of wealthier clients with the asset income, so those with savings, dividends and property. We've obviously seen that there's going to be an increase of 2% from dividend income from April 26, and then again on the property and savings income. So it kind of feels like the reason behind is they felt like asset income wasn't being taxed the same way as earned income from like employment. So that extra 2% feels a little bit like the national insurance charge. Sure. I don't know. So I suppose, like, from, you know, when you're sort of talking to clients, that concern of the rise in income on their asset income, you're obviously going to be having conversations differently potentially about you know, how are they going to invest that. Yeah,
and I think there's a crowding out now of income tax suffering assets. And that's leading to a sort of re-wrapping approach where there's a couple of factors here, as you mentioned, the allowances and the rates increasing, the exemptions reducing over time, and also now you have pensions which have sat silently in the background and been again one of these examples of hold it until you die. Firmly in estate planning. Now that's about to go into reverse. Bringing pensions on the table as well from an income tax point of view crowds out the other assets that are giving rise to income, so it makes them more or less, you know, less tax efficient. So structuring that wealth or resequencing the income, maybe restructuring it for gains, capital gains tax environment, or perhaps into a corporate environment, or deferring, you know, examples of deferring that income.
So more growth fee income.
Exactly, and allowing the pension to perhaps be, you know, drained, and while other assets sit behind it. So that's a sort of circular that we're seeing now that perhaps for the last 10 years clients haven't really had to be that conscious.
No, that's very true. And I think, like you say, with the pensions, that was quite a major change that's being bought in. You know, I've been having discussions with the clients about what they do there, because they've had this pot of cash and a pension that they could effectively give away tax-free if they die. It's not within the inheritance tax remit, so it's kind of looking at ways that they can sort of tap into that from an inheritance tax point of view. And, you know, I still think one of the most favourable and sort of best exemptions out there is the gifts out of surplus income. That was one of the things that I thought that they were going to change in the budget, either like restrict it a bit like they did with the business property relief assets, but they haven't sort of touched it. And, you know, that could be a way of sort of tapping into that pension and passing it on to you know, their family, and not having to survive for 7 years like a potentially exempt transfer, because it would be completely IHT exempt.
I agree, and I think the emphasis now for clients on the pensions is, okay, if we're going to deploy the pension, can we replace the inheritance tax efficiency maybe through, as you mentioned, that sort of gifting out of normal expenditure, or do we look at other inheritance tax efficient assets to invest into, or even using the proceeds to contribute to children's pensions to recover some of the tax relief or gift aid, that sort of thing. So there is that sort of recycling approach that we take. But the other impact to that is clients have typically for the last 10 years allocated their higher risk appetite to the pension.
Okay.
You know, it's been there, I won't really touch it, it sits behind everything else. So I apply a higher risk approach to that, let it grow, let it make the most of these tax reliefs. Whereas now that may mean that clients need to reallocate that risk elsewhere, along with the income sequencing. So there's a lot of sort of review, you know, reviews are quite comprehensive now, I think, across all of these strategies, to keep on top of the new world. Yeah,
and I think, you know, we've seen it in the past that property owners, landlords, they've been hit quite a lot. Sort of landlords have been hit in the past with restriction on mortgage interest, additional stamp duty on properties, even like the favourable tax treatment that had furnished holiday lets have been abolished. You're sort of now seeing the dreaded mansion tax coming in for those properties that are valued over 2 million. That's going to have quite a significant impact on those wealthier clients, but also like landlords with property businesses. And I think when the rules came in a few years ago about the restriction of mortgage interest, many clients were looking at possibly incorporating their portfolio business into a company. So you might see, I'm supposing I might see that more people are going to sort of be asking questions about that, but it can be quite a tricky process. There's other taxes to sort of that come into that need to be considered, and obviously there's a capital gains event transferring properties into a company, but there is something called incorporation relief, which makes that CGT kind of deferred later down the line. But that used to be something that was applied automatically, and we've seen in the budget that from April 26 that's actually going to be a claim that now needs to be made. So it's kind of is that HMRC's way of like challenging the reliefs and then you'll see fewer of it. So I don't know if you've got any thoughts around that.
I think to sort of summarise, really, I think there's a few echoes really of us being back in the era of the 70s in terms of the government is under constraint. We're seeing that there's around 10 pence in the pound now of tax revenue going on just paying interest on debt. So this isn't going to go away. I think the time when you could just rely on what worked a couple of years ago is over, and we're seeing that a much more proactive planning approach is needed, and professionals really can help with that.
Thank you very much for joining us for mine and Lyndon's post-budget debrief and chat. I found that really interesting, so I hope that you did too. If there is anything that's piqued your interest or you do want to talk to anyone or find out a little bit more, then please do contact either one of us or anyone at Francis Clark. But just say thank you again for joining us, and thank you, Lyndon.
Thank you.